Good morning, everyone. Welcome to another episode of the Mizuho Week Ahead. I'm Jingwen, market economist at Mizuho Bank. This week's theme is cooling data, rising stakes. The conflict between US and Iran continued to escalate over the weekend into a full-blown conflict, with both sides trading attacks. With civilian infrastructure like desalination plants and power infrastructure being targeted, hopes of contained military strikes is diminished. The combination of US blockade of the Strait of Hormuz, reimposed sanctions on Iranian crude, and the threat of more significant production outage amid attacks in the Middle East led to Brent crude surging to US $90 per barrel. Beyond geopolitical tensions, US macroeconomic data last week were broadly constructive. Both CPI and PPI pointed to easing inflation pressures in June, largely reflecting lower energy prices. Core inflation remained unchanged from May, while PPI details related some lingering price pressures, particularly within services. Meanwhile, initial jobless claims fell below expectations, underscoring continued labor market resilience. Softer inflation data supported risk sentiments, although equities performance remained uneven as technology and AI-related stocks continued to drive volatility. Despite TSMC reporting stronger quarterly profits, semiconductor shares sold off as investors questioned stretched valuations. This was exacerbated by China's moonshot AI's new model, Kimi K3, that outperformed its most advanced peers. In South Korea, authorities also announced temporary restrictions on new single-stock leverage ETFs and tightened trading requirements to curb speculative activity. Meanwhile, Fed officials continued to send mixed signals. Chair Kevin Walsh reiterated that the Fed has no tolerance for persistently elevated inflation, while arguing that AI-related price increases are distinct from supply-constraining geopolitical shocks. Governors Waller and Cook struck more hawkish tones, citing inflation risks from AI-related investments and Middle East supply disruptions, reinforced by Cleveland's Fed President Hammack, who said persistently high inflation is a bigger concern. Nevertheless, New York Fed Chair Williams and Vice Chair Jefferson maintained that policy remains appropriately positioned for now. Consequently, markets pared their expectations for a July Fed rate hike. In Asia, the Bank of Korea delivered a widely anticipated 25-basis rate hike with hawkish bias, helping the won outperform last week. Meanwhile, China's economy grew weaker than expected at 4.3% year-on-year in Q2, reflecting softer industrial activity, subdued domestic demand, and contracting investment. Expectations are building for additional policy support at the end July Politburo meeting, although any stimulus is likely to be targeted and fiscally focused. Looking ahead, developments in the US-Iran conflict will drive market amid a data-light week. Recent moderation in inflation may prove temporary if energy prices remain elevated, particularly as much of IEA's emergency oil release has already been deployed. Elsewhere, the ECB is expected to remain on hold amid competing concerns over inflation and slowing growth, while Bank Indonesia may raise rates by 25 bps to support the rupiah amid continued vulnerabilities. South Korea's Q2 GDP is expected to be robust, but moderate due to capacity constraints. All in, cooling inflation data offers only fragile comfort, as rising geopolitical stakes keep the energy-driven inflation risk firmly in play. For more information, please refer to our Week Ahead publication or contact your respective sales desk and RMs. And for regular notifications on our market views, please subscribe to our channel and hit the notification button. Thank you.